Hello and welcome. I'm Bola Onifade, Portfolio Manager from Nutmeg's investment team. Today, I'll be discussing why Nutmeg is optimistic about the health of Europe and its markets. Potential interest rate cuts in the Eurozone could pave the way for increased trade and growth in the region. We expect the European Central Bank, ECB, to cut interest rates at its next meeting on the 6th of June. An ECB rate cut would be momentous as it would be the first of the big three global central banks to make the move, with the US Federal Reserve and the Bank of England expected to follow in the coming months. The ECB oversees all countries that use the euro, so it does not cover the whole of the continent. Already in Europe, the Swedish and Swiss central banks have begun their rate cutting cycles, with the latter outside of the EU entirely. So, what would rate cuts mean for Europe's prospects? Lower interest rates from June could bring new borrowers into the market, stimulating spending and investment. While the EU avoided a technical recession in 2023, the region did experience a slowdown in the rate of GDP growth due to the high interest rates brought in to combat inflation. As inflation has fallen this year, rate cuts in the coming weeks should reverse this and boost the economy. While rate cuts are certainly encouraging, the focus of the investment team when analysing European investment opportunities for Nutmeg portfolios is the global trade cycle, which began a path of recovery late last year. History teaches us that the EU's largest economies, such as Germany, tend to benefit as the global trade cycle picks up. Germany is an exporting country, meaning it tends to export more than it imports. The country has suffered from disappointing industrial production recently due to slowing external demand. However, demand for German manufacturing goods is expected to rise, and this is promising for the German economy. And given this country's size, the entire EU would likely benefit. We believe that giants of European industry such as Siemens and Airbus will perform well, as they are industrial stocks that should benefit from a pickup in global trade. This is reflected in our preference for European industrial stocks in our portfolios. Our higher risk portfolios would likely benefit more should these markets rally, as they have more exposure to equities. However, they can also lose value if markets fall. Our investment team will continue to monitor Europe and the market's reaction to interest rate cuts as they happen. Thanks for watching.